The richest families are not waiting for a dollar crisis to diversify. They are adjusting before the crowd feels the risk. UBS published its Global Family Office Report 2026 on May 28th, based on 307 family offices across more than 30 markets. The average net worth in the survey was $2.7 billion. These are not small investors reacting to headlines. These are families managing capital that must survive elections, recessions, wars, currency cycles, tax changes, and generational transitions. The report found that 60% of family offices plan to change their strategic asset allocation in the next 12 months. UBS also reported that 65% expect confidence in the US dollar as a reserve currency to weaken. That single data point explains how rich families think. They do not wait until a risk becomes obvious. They adjust while the system still looks normal. This does not mean billionaires are dumping the dollar tomorrow. That would be the wrong lesson. The US dollar still sits at the center of global trade, lending, markets, and reserves. North American assets also remain a major part of many family office portfolios. The real move is not panic. The real move is concentration control. Concentration risk is easy to miss because it often hides behind things that look diversified. You can own technology stocks, real estate, private equity, bonds, and cash, but if all of it depends on the same currency, same tax system, same political cycle, and same liquidity conditions, your portfolio may have one giant hidden dependency. This is why ultra-rich families think in layers. They think about asset classes, but they also think about currencies. They think about return, but they also think about access. They think about taxes, estate planning, banking relationships, regional exposure, and what happens if a country becomes less predictable. Their question is not only, what can make money? Their question is, what can protect control? That mindset matters for ordinary investors too. You may not need a family office, offshore structure, or private banker, but you do need to know where your risk is concentrated. If your job, home, savings, retirement account, and investments all depend on one economy, one currency, and one policy environment, then you are not as diversified as you think. The practical move is simple. Map your financial life. What currency pays your bills? What currency holds your savings? Where are your investments listed? Which country drives your income? Which interest rate affects your debt? Then decide whether your future depends too heavily on one system. The lesson is not to fear the dollar. The lesson is to respect concentration. Smart money does not wait for certainty. Smart money builds resilience before the market starts charging a premium for protection. Follow hustle logic, one money fact every day.